Oh, good afternoon, everybody, and welcome to our latest tax update. My name is Craig Hughes. I'm a tax director here at Brown Butler Accountants based in Leeds. So today we'll spend the next 45 minutes or so discussing some of the key points coming out of the recent budget. As usual, we have three speakers. There's myself, and I'll cover off corporation tax and other business taxes. Vicky Hughes will deal with private client matters, and Paul Clark will be looking at tax investigations and such like. Due to a bit of a technical issue today, Vicky and I are sharing a room, so there'll be a bit of a changeover between the two of us. We'll have time at the end to deal with any questions, so please feel free to send them as we go along using the Q&A button in Zoom. And the webinar will be recorded and be available on our website in a day or so. So without further ado, let's kick off with business taxes. So some of the highlights coming out of the budget, well trailed beforehand, of course, but we had confirmation of the increase in the corporation tax rate to 25%. There was a little bit of speculation before the budget about whether that would be reversed, but no, it is definitely going ahead. And also the associated companies rules are being reintroduced as well. And that's what I'll spend a fair bit of my session talking about in terms of how those are going to impact you going forward. It was confirmed that the annual investment allowance will remain at £1 million per annum. But what was new that was introduced was this concept of full expensing for certain capital expenditure by companies only. This is replacing the super deduction. And again, I'll come on to that in a bit more detail shortly. And likewise, I'll go through some of the changes that are afoot as far as the R&D tax relief regime is concerned. So first of all, looking at the change in the corporation tax rate and some of the headlines around that. From the 1st of April, the corporation tax rate is going up to 25%. And this is for companies with profits over £250,000. We will still have the 19% rate, and that will apply to companies with profits up to £50,000. We've then got this marginal rate in between 50 and 250, which works out at 26.5%. Now, what is being reintroduced, as I mentioned, are the associated companies rules. And what that means and why that's important is because those limits of 50,000 and 250,000, they are divided by the number of associated companies in an accounting period. So whilst a company may have profits of, say, less than £50,000, if there are a number of associated companies, it could mean that limit for the small companies rate is far less than 50,000. And those limits are also reduced on a pro rata basis for short accounting periods as well. There is an exception to the small companies rate, and that applies to what are known as close investment holding companies. And these sort of companies always pay corporation tax at 25%. So a company is a close investment holding company unless it carries on a trade, it lets land and property commercially, or is a holding company of the above companies. So typically, a close investment holding company will be a company which lets property to connected persons. So it might be an opportune time to look at group structures, look at corporate structures, decide whether those associated companies are actually required, because it will have an impact both on the corporation tax rate, and I'll come on to shortly around the impact on quarterly instalment payments for corporation tax as well. Quickly just looking at the effective tax rates arising as a result of the increase in the main rate of corporation tax. You'll see there that comparing 22-23 with 23-24, the overall conclusion around taking a small salary and a dividend as compared to taking profits out completely in salary, the conclusion is broadly the same, in that a mix of salary and dividend will normally be the cheaper route, but you will see that the gap is narrowing between the two. And one of the reasons for that is that with the increase in corporation tax rate, because a salary is tax deductible for a company, it means that the effective rate of tax overall comes down slightly. What it also means, looking at that table now, is when you're looking at perhaps incorporating a partnership or an unincorporated business, that cost benefit is now more of a calculation to look at than perhaps necessarily previously. Now, I mentioned quarterly instalment payments just a while ago regarding associated companies, and there is a fundamental change in how quarterly instalment payments are going to be calculated in terms of the methodology, re the number of companies you take into account. Now, just as a reminder, quarterly instalment payments, or QIPs, it applies where profits of a company are above 1.5 million. Profits for these purposes had its own definition. We refer to them as augmented profits. Now, it's usually taxable profits, but it also includes income from non-group companies. So whilst that dividend income might be, or will be in 99% of cases, not taxable, it is brought into account when you're looking at that 1.5 million if it's not from a group company. Now, when we're looking at that 1.5 million limit, up until now, we've simply looked at it from a group perspective. So you looked at the corporate group, you looked at how many companies were in that corporate group, and that's the number you divided that 1.5 million limit by. However, for accounting periods commencing on or after the 1st of April 2023, that limit will now be based upon the number of associated companies at the start of the accounting period, rather than the number of group companies. Now, clearly, that could have some wide ramifications if you had 2 or 3 companies which were under common ownership but weren't in a group. At this point in time, each company has a £1.5 million limit for quarterly instalment payments. But going forward, those 3 companies will only have a £500,000 limit for QIPs purposes. And therefore, those companies could be brought into the quarterly instalment payments regime. Now, there is a little bit of a relief here from a transition point of view, in that if you move from being a small company into being a large company, and a large company here having profits of more than 1.5 million, ordinarily, that first period you move into being a large company is what's known as the transition period, and you don't fall into QIPs for that period. It's in the second successive year. However, that grace period doesn't apply for what are called very large companies. Now, these are companies where the taxable profits or the augmented profits are more than £20 million. And again, that's divided by the number of associated companies for periods commencing on or after the 1st of April 2023. And the bad news, if you're a very large company, is that not only do you not benefit from the grace period of moving into quarterly instalment payments for the first time, but also those quarterly instalment payments are accelerated in that you pay them in months 2, 5, 8, and 11 plus 14 days of the year. So the whole of the corporation tax liability is paid for within year. Whereas for large companies with the £1.5 million limit, those quarterly instalment payments you pay 2 in the year and 2 after the end of the year. Now, there is another important point to note here, that not only is there no grace period if you are a very large company in the year, also if your profits are above £10 million, and again, this is the augmented profits, if they're above £10 million for the year, prorated prorated by the number of associated companies. Again, no grace period there. So this is something to be mindful of over the next couple of years, in particular, in that there will be a number of companies who previously didn't have to worry about quarterly installment payments. It's now going to become more relevant, particularly if there are associated companies. So as I mentioned, from the 1st of April this year, the associated companies point is important both from a corporation tax rate perspective and also from a quarterly installment payment perspective. So what do we mean by associated companies? Well, it's companies under common control. And when we're looking at the rate of corporation tax, so we're looking at the £50,000 and £250,000 limits, what we need to be looking at there is companies that are associated at any time during the accounting period. So it's not at the start, it's not at the end, it's at any time during the period. Therefore, being associated for even one day in an accounting period will count for the purposes of prorating the £50,000 and the £250,000 limits. You do ignore dormant companies, but those companies do need to be truly dormant. HMRC argue that any gainful use of the assets represents a business and could represent that company being active. Typically, what you would want to see is any activity in that company being limited to dividend flow throughs. So if you think about the holding company, subsidiary pays a dividend to the holding company. If all of that dividend is then passed on to the ultimate shareholders, then other things being equal, if nothing else is going on in that holding company, that should be classed as dormant. But if it's got some activity elsewhere going on, if it's got some bank interest, for example, or other items going through the profit and loss account or balance sheet, then it's unlikely to be treated as dormant, and so would be brought into account for these purposes. So what do we mean by associated company? It's if one of them has control of the other, or they're both under the control of the same person or persons. And for these purposes, the definition of control is if somebody exercises or is able to exercise or is able to acquire direct or indirect control over the company's affairs. And the legislation goes on to say, in particular, if you're entitled to acquire the greater part of the share capital or issue share capital, voting power, distributable income, or net assets on the winding up, again, you will control that company. So we're not just looking at voting rights and share capital here. It's a far broader definition of control. The other point we need to be mindful of when we're looking at associated companies is that shares of a person's associates could also be taken into account. Now, this only applies if there is what is called substantial commercial interdependence between the companies. And I'll come on to that shortly in terms of what that means. This is an important point in that when you're looking at who controls a company, it may not just be the existing shareholders who are there, it could be relatives of them as well who we need to look at if they are involved with other companies as well. So when we're looking at this point around attribution of the rights of associates, we're looking at relatives, we're looking at business partners, any trusts created by the same person, and personal representatives of any settlement in which they have an interest. So again, can potentially be quite a broad range of people. For these purposes, relatives includes direct family relationships and therefore would not include aunts, uncles, cousins, nephews, nieces, and the like. So we're looking at direct relationships. But nevertheless, an important point to bear in mind in the context of family businesses, where there are several companies potentially controlled by different members of the family. They may all be associated for these purposes. Now, I mentioned that The only time we need to take into account associates or relatives of associates is if there is substantial commercial interdependence between the two companies. And there are three categories of interdependence. There's financial interdependence, and this is where one company gives financial support directly or indirectly to another. There's economic interdependence, and this is where two companies would be economically independent if they seek to realize the same economic objective, or the activities of one is similar to the other, and they both have common customers, for example. And then there's organizational interdependence. And this is where there may be common management and employees, common premises, or common equipment. If there are shared premises, for example, that can lead to organizational interdependence. And it's only one of those categories that need to be satisfied in order to be substantially commercially interdependent on another company. But overall, the point to remember here is that the attribution of rights held by associates is not intended to apply where there's an accident or circumstance, but where there is a means of interdependence between the parties. There is actually a will for those two companies or three companies to be working together, either financially, economically, or from an organizational perspective. Still keeping with the theme of associated companies, when we're looking at whether one company is associated with another, what we need to look at is the minimum controlling combination. So this is the minimum number of people controlling one company, which is the same as the minimum controlling combination of people who control another. And again, you would include associates within that if there is substantial commercial interdependence. But there has to be the identical parties in both companies. So it's a group of persons which has control of the company, but which would not have control of it if any one of the persons was excluded from that group. I'll come on to a couple of examples now to show exactly how that works. So first of all, we have two companies, Caddy Limited and AC12 Limited. In Caddy Limited, Mr. Arnott owns 60%, Mr. Hastings 20%, and unrelated others have 20%. In AC12, Arnott has 40%, Hastings has 30%, and others have 30%. Arnott and Hastings aren't related. So between them, Arnott and Hastings do control both companies. However, Mr. Arnott can control Caddy on his own, and therefore he is the minimum controlling combination. He does not control AC12 on his own, and therefore in these circumstances the two companies are not associated. You're looking at the minimum controlling combination. A bit more of a complex scenario here, again, just to show how this minimum controlling combination concept works. We have X Limited, which has A, B, and C as shareholders, owning shares 45, 45, 10. And then we have Y Limited, which has A, B, D, and E as shareholders, with 40, 25, 20, and 15, respectively. So when we're looking at the minimum controlling combinations for X Limited, it could be A and B, it could be A and C, or it could be B and C. For Y Limited, it could be A and B, A and D, A and E, or B, D, and E. Now, there is a common minimum controlling combination there in that A and B. So A and B together can control X, and A and B together can control Y. And therefore, they are associated because they have the same minimum controlling combination. Right, I think we've had enough now talking about associated companies and the potential issues that are going to rise going forward as far as they're concerned. Let's turn our attention to capital allowances now and the changes that were announced in the budget. The annual investment allowance, as I mentioned, it's now set. It's now £1 million on a permanent basis. It was set at £1 million in January 2019, initially on a temporary basis, but that's now been made permanent. And just a reminder, that applies to unincorporated and incorporated businesses, excludes cars, but you can have new or second-hand assets. Now, what was new in the budget, which was announced, was this concept of pool expensing. This is to replace the super deduction, which is ending for expenditure up to the 31st of March 2023. So no super deduction after the end of this month on expenditure, but it's being replaced by full expensing. Now, initially, this is put in place for a 3-year period to March 26, but there is an expectation that it will be extended beyond then. Now, in a lot of respects, it's similar in operation to the super deduction, but without the 130% enhancement, which a super deduction gave. But in essence, the tax relief is going to be the same. Because if you think about it, the super deduction gave 130% enhancement on the deduction. The corporation tax rate was only 19%. So the effective tax relief was nearly 25%. Lo and behold, we now have a 25% corporation tax rate, so a 100% first-year allowance gives pretty much the same result. So what does it apply to? Well, it's the 100% first-year allowance for main rate expenditure. So that's assets in the general pool, plant and equipment, commercial vehicles, and such like. There's a 50% first-year allowance for any special rate expenditure. So these are typically your integral features, heating and lighting systems, assets within buildings, that kind of thing. Now, it excludes cars, as the annual investment allowance does, and excludes assets which are leased out. However, there is an exception, like there is for the super deduction, for assets embedded in buildings which are let. Now, the full expensing only applies to new and unused assets, and it only applies to companies. And as with the super deduction, when an asset upon which full expensing has been claimed, when it's disposed of, there's a balancing charge arising. So in most cases, the annual investment allowance will be ample. It's £1 million now, and most companies, for most companies, that is sufficient. It has the advantages that it's a broader range of assets which it can apply to. And of course, applies to unincorporated businesses as well as companies. And you don't get the balancing charge when an asset is disposed of, although that will largely depend upon what value is in the capital allowances pool at the time. But the full expensing will be relevant for companies who do reach that £1 million annual investment allowance, and therefore it gives an additional first-year allowances for those sorts of companies. Now, finally, just looking at some changes announced for R&D. So for expenditure after the 1st of April 2023, it was confirmed that the enhancement is reducing from 130% to 86%. Again, this was mentioned in the autumn statement, but that's been reconfirmed. The repayable credit is reducing from 14.5% to 10%. However, there was a relaxation on this announced in that the 14.5% rate will be retained for what are called R&D intensive companies. Now, very broadly, these companies are ones whose R&D expenditure is at least 40% of the total expenditure of that company. So it's likely to apply only in limited circumstances, but nevertheless, there is some relief there. Now, with the increase in corporation tax rate to 25%, what that means is that the overall R&D relief is now worth 21.5%, compared to 24.7% as it is at the moment. And the benefit of the repayable credit, now that's reduced significantly from 33.35 to 18.6%. And this is where the 10% repayable credit applies. On the flip side, the RDEC, so this is the Research and Development Expenditure Credit, so the regime for large companies, that has increased from 13 to 20%. So the benefit of that has gone up to 15% from 10.53. Now, there is a consultation that's been launched to amalgamate the two schemes. So we have the SME scheme and the RDEC scheme at the moment. There is a lot of logic in combining the two into a single scheme that's easy to understand. Now, we're expecting announcements in April 24. Whether that is sufficient time for that new scheme to be launched then, who knows? But that's that's certainly the target date. Finally, on R&D, from the 1st of April 2023, there's going to be a requirement for some companies to supply a claim notification. This will be companies which are claiming R&D for the first time, or companies who have not made an R&D claim in the previous 3 calendar years. And then a surprise that came out in the budget was for all claims. So this is irrespective of whether claims have been made in the past or not. For all claims being submitted from the 1st of August 2023, an online form will now be required, which will include details of the projects and the costs being claimed. So this is for claims submitted after August, so it doesn't matter which accounting period it relates to. If the claim is submitted to HMRC after the 1st of August, these additional details will be required. This is an additional compliance burden, which undoubtedly will result in additional costs of putting the claim together, and therefore that needs to be borne in mind when considering the cost benefit of making an R&D claim. So that's all I want to talk about as far as business and corporation tax is concerned. I'll now hand you over to Vicky to talk about private client matters. If you just bear with me 1 second.
Good afternoon, everyone. I'm going to talk through the private client aspects, as Craig mentioned. But first of all, I thought it'd be useful to do a recap of some of the main announcements that were made in November in the autumn statement. So just as a reminder, and if these are coming as a surprise to you, we did cover them in more detail in our December one of these. So the threshold for the additional rate of tax is reducing down to 125,140 from the start of the new tax year. So that's reduced down from 150,000. The personal allowance, basic and higher rates of tax, the thresholds are all frozen until April 2028. We've got reductions in both the dividend allowance and the CGT annual exemptions. They're reducing next tax year and then again the following tax year. And again, the rates of tax themselves are unchanged, and that's going to continue until April 2028, we believe. Then we've got nil gain, nil loss transfers on separation and divorce. These are more favourable tax release and give a bit more time for people that are going through that scenario. They've been confirmed that they'll take effect from the 6th of April 2023, and they're being included in the statements and the legislation that's coming in. And there have been no changes to the inheritance tax exemptions. So both the nil rate band and the residence nil rate band are frozen until April 2028. So as a result of these reductions and freezings, we've got this concept of fiscal drag, which is going to take us through to the 5th of April 2028. So although tax rates haven't been increased, because the allowances haven't gone up, that means more people are going to fall into the increasing and have to pay increasing amounts of tax. So HMRC will get increased tax revenues without actually having to increase any of the headline rates of tax. What this means is that everybody needs to plan more carefully, and where we're advising clients, we need to help those clients to plan more carefully to maximise all exemptions and allowances that they've got. It will be something that will need careful monitoring, and people will want to avoid, if possible, falling into the additional rates of tax. And as a result of people paying more tax, it will also mean that more people actually have to report income tax and capital gains tax to HMRC. So there could be some people that have never been in this position before. They've not had an obligation to submit returns, and they'll fall into that category and will need assistance to understand what they need to do so that they don't fall foul of, interest and penalties, etc. So now that I've cantered through a reminder of what's happened before that's coming into effect from the 6th of April, these are some of the announcements that were made just a few weeks ago in the spring statement. And one of the real surprises was the generosity of the pension changes. I think people were thinking that something might happen, obviously, to try and stop people, and especially consultants, leaving the NHS. But what they've done is much more generous. So they've abolished the pension lifetime allowance. So it's fairly technical how they've done this, but the basic outcome is that from the 6th of April, there won't be any lifetime allowance charge. So there'll be no penalty for putting too much overall into pensions, including the growth of those pensions. And then actually from the 6th of April 2024, the lifetime allowance will be abolished completely. And at the moment, that allowance is just over, 1,073,100, as it mentions on the slide. But the main thing is from the 6th of April 2023, there won't be a charge, so there'll be no penalty. But what they have done is keep the tax-free lump sum static at 25% of the previous lifetime allowance. So that means that it's only tax-free if you're lucky enough to have a pension that big. You're only tax-free on the lump sum up to 268,275. And then anything over that you'd be allowed to take would be charged at the marginal rate of income tax. It is possible that some individuals have got protected lump sums above this level to do with the different changes that have happened over the years. And if an individual does have a lump sum greater than I've mentioned, that remains in place, and they'd still get that tax-free. So another thing connected with the pension changes is that they increased the annual allowance, and very broadly that's the limit on the tax relief for pension inputs in a particular tax year. At the moment, it's currently £40,000 that can go in each tax year, and from the 6th of April that will rise by 50%, so it'll be £60,000 that can go in. Now there are some other technicalities. Once an individual has accessed their pension and taken the flexible access, the money purchase annual allowance is currently £4,000 per year. And again, that's increasing, so that will be £10,000. And basically there's rules that say, how much income you can have before what you can put in is reduced. And that 10,000 will be reached where the adjusted income for these purposes is 360,000 or more. So there's fairly generous changes have been made to the pensions. It possibly won't be applicable to all clients, but it is something to bear in mind, and does mean that people can put more money away for their futures in a tax efficient way. And what they did mention is a few years off, but they have said that relief at source could well be digitalised in a few years' time, which would make the claiming of that extra tax relief more straightforward. So moving on to the next few slides, summarise, briefly some other announcements that fall into the personal tax arena. So there are going to be changes to the self-assessment tax forms to do with crypto assets. This is in particular the capital gains pages, and that will require that the amount of crypto assets that have been disposed of are separately identified. Now, cryptocurrencies are an increasingly popular investment, and it's something that the revenue are conscious that people might not be reporting correctly. So having them in separately identifiable boxes will be easier for them to cross-check, analyse, and potentially raise inquiries. Just a reminder here, there haven't been any changes to the ISA subscription limits, so they remain the same level. They've announced a consultation that would expand the cash basis of taxation for small unincorporated businesses. They've also confirmed that there will be a restriction of charitable reliefs to limit those to just UK charities and community amateur sports clubs. This is something that links into Brexit and the move to be able to focus on UK aspects only. So from budget day on the 15th of March, these reliefs are subject to a transitional period, but basically from April next year, you won't be able to claim charitable relief on non-UK aspects. So that's a restricting of that relief. They've also announced that they're having a discussion document about modernising HMRC services, and there's the thought that, you know, move to more digital by default, so limiting who can actually say that they, you know, can't do things online. So they're very much going to restrict being able to do paper returns, for example. That hasn't come in yet, but it's definitely the way that we're going. And there were within the budget papers and the announcements, there were some comments on agricultural property relief and woodlands relief for inheritance tax purposes. So the fact that this is included can be seen as a positive, that they're potentially not looking to get rid of agricultural property relief, which, you know, would be an extreme thing to do, but is something that's been mentioned over the years to do with simplifying and updating inheritance tax. But what they are saying is that from the 6th of April next year, so 2024, they're restricting the scope of these reliefs. And again, that's restricting it to property that's within the UK itself. So that would remove the current extension that's in place that allows property situated in an EEA state to also qualify for that. They've also mentioned that they're launching a consultation on agricultural property relief. Things develop over time, and they're looking into the possibility of extending it to some types of environmental land management. So again, if people are interested in doing more environmental aspects with their land, this could be seen as a potential positive step, because there's the risk that if you have to leave your land fallow to seek to do environmental things, then the revenue could deny you relief because you're not actively farming. So it'll be interesting to see what comes of these over the time and when they've got the feedback. So another thing that was in there to do with personal tax is linking into trusts and estates, which can be a particularly complex area. And these changes are coming in for income tax from the 6th of April 2024, so not immediately. They're seeking to ensure that trusts and estates with income up to £500 don't have to pay tax on that income as it arises. And equally, that beneficiaries of UK estates wouldn't have to pay tax on amounts that were paid to them that fell within this £500 limit. So that would be an increase over some of the positions that they take at the moment. So that would be helpful. They've also indicated that they intend to amend the inheritance tax regulations to remove some of the reporting requirements for trusts that don't actually have a tax liability. So again, that will be interesting to see what that does, and potentially it'll be increasing the figure to the nil rate band of 325,000 rather than being a level that, well, the figure of 260,000 at the moment that applies in some circumstances. They're also proposing that the current tax rules that apply to accumulation and discretionary trusts, where the first £1,000 of income is taxed at a lower rate rather than the trust dividend rate, are actually going to be appealed. So essentially that would mean that from the 6th of April 2024, the tax rates will be rising, albeit modestly, for these types of trusts. And again, that's something to bear in mind if you're discussing this position with clients, or indeed you have trust yourself. And just a final reminder that is something that you may be aware of. It has been mentioned in the press, but there is the possibility of people making voluntary national insurance contributions if they've got gaps in their national insurance records. At the moment, it's possible to go back and fill gaps from April 2006 onwards, which is obviously quite a long period of time. But from the 1st of August, it will only be possible to go back 6 tax years and fill those gaps. So obviously there's a significant scope to improve your pension position if you have these gaps. Now, there's a lot of discussion about how to do this and what particular age categories this might be the most attractive to. And I think there's mentioned that it's from age 45 onwards in particular. But if you feel that you or your clients could be in this position, it would be sensible to look at it as a matter of priority, because you can get the details online for your NIC record. And if you need to make the payments towards it, there obviously isn't much time, and the helplines to do with this are particularly busy. So I hope that's a helpful reminder of what was mentioned in the statement and also this national insurance point to bear in mind. I'll pass you over to Paul to talk about his investigations and inquiries aspects.
Thank you, Vicky. Good afternoon, everybody. I would like to update you with 3 slides that I've selected in the field of tax investigations and inquiries as regards the budget a couple of weeks ago, and a further slide to highlight the increasing activity that we are seeing by HMRC. But to begin with, this first slide I put together is designed to demonstrate to us the direction that the government and the Treasury and HMRC are heading as regards tax fraud on the one hand, and also tax avoidance on the other. Now, tax fraud, as we all know, is illegal activity. It's fraudulent. It is criminal activity, and it isn't a typical case that we as practitioners will see. It's more the domain of criminal practice lawyers and barristers. But the point here is to highlight, to begin with, where the government are going with this is that they have seen some severe cases of fraud in the recent past. And the maximum jail sentence is 7 years. So what they are going to do is to double that now to 14 years. Now that's in the field of tax evasion. Tax avoidance, which is strictly within the law, but pushes the way particular schemes are packaged to the boundaries of the way that the legislation was intended to be applied when it was brought in by Parliament. And the statistics go that there is £400 million a year that is lost to marketed tax avoidance schemes. Now, it was once the case that those schemes were taken up by the higher earning individuals, the wealthier individuals, for example, employee benefit trusts that many of you will be familiar with and will recall. More recently, what's happening is that this area, so to speak, is now increasingly being dominated by employment agencies that are putting together packages whereby umbrella companies are targeting contractors and agency workers. And despite the fact that a number of those promoters have been identified and effectively been taken out of the market, there is still a significant number that the government is determined to deal with. So what they are now proposing is, for the first time, this is to criminalize what has always been within the law. It may be obnoxious to many, it may be unacceptable behavior, but it wasn't illegal. Now, where the government are going with this is they are saying enough is enough. We are determined to drive these promoters out of the market. And if they will not take steps to comply with a legal notice issued by HMRC to stop them promoting a tax avoidance scheme, then they will be liable to a criminal offence. And the other area that the government and the Treasury are heading with HMRC is that they are, as a result of the budget announcement, putting another £47.2 million to improve HMRC's capability to collect tax debts. The collection tax debts as a figure is currently running the order of approximately £48 billion. This is tax that's been identified as collectible, so it isn't in dispute in principle, but it hasn't been collected. It still is outstanding, it's unpaid. And that is twice the level as it was pre-pandemic. And what the government is seeking to do is plainly drive that figure down. In my experience, and this is the point I really want to share with you, from time to time, we do have discussions with what's known as HM Revenue and Customs Debt Management and Banking Unit. Now, they are normally quite sympathetic to a reasonable request if a company or an individual genuinely can't pay an amount that is recognised as payable, but they just can't pay. They can't afford it. They don't have the means, don't have the cash flow. If you tackle that item with debt management and banking early on, they will be very prepared, in my experience, to offer quite acceptable time to pay terms. Because what you do not want, and we are probably going to see more of this now, is once the Exchequer look to recover these amounts of outstanding tax, is that they will run out of patience with a number of cases. And before the company or the individual realizes, it may be in the hands of what's known as enforcement office. Now, enforcement office are a group of people that are really at the end of the line in terms of tax recovery. They have no desire to offer any terms. Their remit is plainly to get the money in. So the message I have is if you have clients or you have a business whereby it's recognized that amounts are owing to HMRC, and as yet, HMRC haven't unduly pressed for that, but the signs are that they will be, is to talk to debt management and banking and arrange some payment terms so that the cash flow can cope with it. This is a particular topic that I thought was well worth mentioning. Vicky has touched on it in the private client section, but the reason that I've identified it for spending a few moments is that HMRC have always been suspicious of crypto assets and the way they've been reported. And what they're going to require is a greater scrutiny of the reporting so that they can identify how assets have been held and if they have been disposed of, so they can, if needs be, inquire into this in far more readily than they have up to now. And what they are saying here is that it will include all cryptocurrencies and what's known as non-fungible tokens, these NFTs that we hear of. All crypto assets will need to be identified separately on the UK tax return from 2024-25. That isn't too far away in terms of discussing this with clients. There is a typical type of client that is quite active in this area. And the requirement to report the gains and the income will give HMRC a far greater opportunity to inquire into these transactions, particularly if they don't match up with the information that they get from the trading platforms, the Coinbases and the Binances of this world. And it's worth bearing in mind and making clients aware that even though on the face of it, they may not have transacted any matters for capital gains tax purposes, they may have done, in that transfer of a crypto asset or a currency to another such unit is a disposal for UK tax purposes. Most clients won't automatically think of that. So it's well worth drawing that for clients' attention, particularly if they are increasingly active in this area. It's probably no coincidence either that this is coming in at the very time that the capital gains tax annual exemption will be further reduced. So it will capture more and more transactions, and there is no coincidence, I'm sure, to this. In the field of tax compliance checks that HMRC undertake, and I've seen quite a number over the years, whether HMRC undertake it on what they call a cross-tax check, or whether they just confine it to what they call employer compliance, which is payroll-related, benefits in kind. It's that area of a business. And almost invariably, even the most diligent of clients will fail in some regard to properly return always the benefits for tax purposes, particularly if they have a wide-ranging number of individuals that have benefits provided. And we are increasingly seeing more and more of different categories of benefits in kind being provided by employers to individual employees. And the capturing of that is increasingly difficult. Most clients try their best, in my experience, but it's an area that HMRC know that they will almost always, once they inquire into this area, will find something. It's fertile territory for them. And this is why I thought this announcement was a very helpful step to alleviate the problem for clients. Now, this is, and it was an announcement that was hidden away in ancillary documents. There was no timescale put on it, nor was there much information provided. But in outline, what the announcement was is that HMRC plans to allow tax agents to be able to payroll benefit in kind expenses for clients. Now, this is for the first time this has been offered by HMRC. And it's part of the government's long-term strategy to simplify the tax system for taxpayers and their agents. And it will cover a wide range. Almost all the benefits that are provided to individual employees will come within this. For example, company cars, health insurance, travel and entertainment expenses, childcare. These are types of categories of benefits that are widely used and welcomed by many employees, and employers are happy to provide them. I think the only benefits that won't come within this, as far as I can see, are the living accommodation benefit, which you don't tend to see a great number of, although there are a few still out there. Nor will it include interest-free or low-interest loans. So both of those will still have to go on appeal and D. But otherwise, this will be a very helpful step. I mean, we are handling a case at the moment, for example, where quite a large organisation with a significant number of employees tries very diligently to make sure that all their returns are correct, their payroll benefits, their P11D benefits, but in error and in just as an oversight, they haven't appreciated the distinction between payrolling and P11D benefits for national insurance purposes. We've been looking at this with them and are doing a disclosure at the moment to HMRC, totally unprompted. HMRC don't know anything about this, but it just demonstrates how difficult the area is. And in my view, this is a big, helpful step to make life easier in this regard for a large number of employers, and it's to be welcomed. This is an area that we are seeing more and more HMRC activity. And so this isn't necessarily something that was announced in the budget. In fact, it's been going on for a little while now. HMRC decided a little while ago, and I have touched on one or two examples in recent presentations, that it would be a very good use of their increasingly finite resources of manpower, rather than to raise individual inquiries by inspectors or compliance officers, but rather to use the massive amount of data that they have in their systems now. And under the, you may have heard of the Connect system, which is a huge computer system that HMRC invested into a few years ago. And what these one-to-many, these OTM letters, as they call them, or colloquially known as nudge letters, is they seek to take a particular activity of a number of taxpayers or a section of society or a type of industry sector and effectively merge electronically from a list of names a generally bland worded letter which basically says you may want to consider whether your tax return is correct, and if it isn't, please let us know and make a disclosure. Hence the nudging of the client or the taxpayer into making some sort of a disclosure if one is felt necessary. One of the areas I mentioned recently in an earlier presentation at the end of last year was the Euro-Pacific bank cases of 600 people that had a letter along these lines indicating that HMRC was aware that they had an account in an overseas bank somewhere in Central America, and they might not have, as a client and taxpayer, returned the income arising. Now, whether that was right or not is another matter. But what it does is it places the onus on the individual or the company. And it's a very low-cost way of HMRC making a number of individuals or companies come forward with disclosure items. The latest ones that they are doing are these three here. Research and development claims. Craig has outlined how the rules for R&D tax relief will change shortly. But what we're talking about here are companies that have made R&D claims in the past. They may have only made one claim, or they may have made several claims. Now, in the early days, when R&D tax relief was introduced 20 odd years or so ago, the direction to HMRC was to process those claims and repay the claims quickly for all the right research and development reasons. Unfortunately, over the years that have followed, there are some organisations out there that have put together claims which are bordering on the fraudulent, and HMRC are saying we have had enough of this. They say that according to their latest statistics in the year 21-22, it's something like £480 million worth of erroneous or fraudulent R&D claims they anticipate have been incurred. So they've decided enough is enough. And a number of these letters are now going out and have been going out for the last few months. At the end of last year, 2022, letters went out to 1,000 companies in October and 1,000 companies in November. 2,000 more letters went out in January this year. And it's a generally worded letter, which basically says you have undertaken a research and development tax claim. Have you satisfied the following tests necessary for research and development? They're not saying that the claim is incorrect, but what they are saying is have a good look. And if you think in the cold light of day that you need to make a disclosure, then please do so. We, like a number of other firms, have professional fee protection insurance for clients in the unlikely event of them receiving a compliance check. And I was speaking to one of the R&D consultants at the company, the insurance company that we have our policy with, only 2 or 3 weeks ago. And he was saying they are seeing a significant number of these now being put to them. So it's a very concerted area of activity by HMRC. And if you have clients that have made R&D claims that haven't as yet received this form of letter, then there is every likelihood that they will do so shortly. What you need to do is be very careful. It's not to say the claim was incorrect, but it's to basically reconfirm the propriety of the claim and the principles on which it was claimed to make sure it does satisfy the tests for R&D tax relief purposes. A couple of other areas where these one-to-many letters are now being sent out. Short-term property letting income. This is basically people who let out properties, typically on, for example, Airbnb. Airbnb has become very popular. It's become very lucrative for a lot of property owning individuals. Airbnb are required to submit returns every year to HMRC, and it doesn't take much activity for HMRC to review that list against tax returns submitted. So it's an area that if you have clients letting property short-term basis on Airbnb, for example, is to make them aware of this area of activity by HMRC. Business asset disposal relief. This is a bit of an odd one, really. This is a capital gains tax relief designed, as its name suggests, when an individual client makes a disposal for capital gains tax purposes of a business asset. And that therefore applies to a relatively small number of individuals. However, what HMRC are saying is that they're going to look at those claims made in the tax year 21-22 to make sure, for example, that the £1 million limit, lifetime limit, hasn't been exceeded either in isolation or collectively over a period of time. So if you have clients that have claimed it, you've been involved in preparation of their tax returns, then make them aware that this may be a line of inquiry. And finally, just briefly, not least with one eye to penalties that arise if a disclosure is required, HMRC make a distinction between what is a prompted disclosure, in other words, if they knew about it already, or it's as an alternative, an unprompted disclosure, because they have no knowledge of it until the disclosure was made. It was a voluntary disclosure, if you like, and thereby unprompted. It's a fine point as to whether these nudge letters have any legal basis as regards the type of behaviour, because they have no legal status as a letter. And similarly, legislation states that where it comes to the attention of HM Revenue and Customs or an officer, well, these letters have been put together by mail merge, basically. So it could be an area that from a technical perspective, we need to press if the matter of is it a prompted or unprompted disclosure for penalty purposes does arise in due course. And there we are.
Thank you, Paul, and thank you also to Vicky for your contributions today. We do have just a couple of questions that have come in. One is a dead straightforward one in that I missed the first section of the webinar, kind of the slides. Just to remind everybody, the webinar is being recorded, and so there'll be a link on our website in the next couple of days for that, so you can revisit it and watch it again if you so wish. Another question that came in regarding the change in the R&D rates from the 1st of April 2023, and just to confirm, it's expenditure from 1st of April 2023, which falls in the reduced enhancement now applies. So if you have an accounting period which straddles 31st of March, then you'll have some R&D which will be calculated under the existing regime. So you'd have the 230% uplift, whereas expenditure after the 1st of April will only get the 86% uplift. So just a clarification there. So thank you all again for attending. I hope you found it useful, and we look forward to seeing you again in about 3 months' time, all being well. Thank you very much, and goodbye.